Welcome back to the channel, guys. My name is JULIUZ and I'm watching the best videos of the trading industry with you together so you don't have to do it all by yourself. Today I want to react on Andrea Cimi $1 versus $1,000 trading chart. So today again a little bit more on the technical side, not just the entertainment side, but also where we can learn something. Okay, so let's get right into it. Let's take a look at $1,000 trading chart and if it really makes you more profitable, and then I'll also explain to you how I'm trading and which charts I'm using. Okay, so you guys leave a like and a sub down below real quick. Thank you for your support, that helps a lot. And now let's get right into it.
In this video I will show you the #1 absolute best trading charts that exist and how it works to get absolute sniper entries. But we'll also see the second best type of chart that professionals use every single day and much more, all the way down to your
Okay, let's take a look at the professionals real quick.
Use
which one do I recognize? This one is a German guy.
every single.
This one is Tom, one of those trading World Cup winners. Yeah, he's probably using level 2 data. But Tom Hugard, on the other hand, is not using level 2 data. He's basically just using basic level 1 technical analysis 15-minute charts, okay?
And much more, all the way down to your good old boring candlestick chart. This is a candlestick chart. Every trader starts by learning how this works. Each and every one of these candlesticks provides you with 4 pieces of data you need to know. The open and the close will create the so-called body of the candle. The high and the low are these little wicks you see on top and below.
So I'm actually one of those people who say that a candlestick chart more or less is everything you need, because you will see where the big volume spikes are, because then the candlestick chart finds usually a big support or resistance at this location. I don't think that it is so important to see where the liquidity is, because usually it's pretty obvious. If the market is in a very big upwards trend, usually liquidity gets aggressively put in higher and higher and higher, and the market is consecutively grabbing those liquidities on its way higher. If the market is in a retracement and we leave a big top behind, then usually there's big liquidity above and big liquidity below. Very obvious. Okay, I think for professional good trading, a candlestick chart is more than enough, and there are enough examples of very good traders who only trade with a candlestick chart.
Which means that price started here, went below here, all the way up here, and then closed around here. Open, low, high, close. And most traders will analyze price action charts by looking at highs and lows in how this price action unfolds. And they will try to buy when price is low, putting a stop loss below the previous low.
So this is a 5-minute chart, and basically you could have just traded basic support and resistance here. Okay, of course this is support when the market is coming from above. Okay, you could have already tried here at this point. On the second look, it's really obvious. Okay, look at this, just this movement, just on the basic candlestick chart. You could trade support level here and hold the trade until this resistance up here. It's so obvious. Okay, and then the market is coming back down. Now we have support here that got tested. You could have traded this one. It's very simple.
And take profit when price rises. And then they will draw rectangles wherever price is bouncing. So if price from going up starts going down, that will be a resistance area. If price goes down and then rises, that will be a support area. Support, resistance, and so on and so forth. And most retail traders that trade like this end up never making money, really. And 99% of traders who use
I don't think so. If you're trading good risk and a decent reward risk ratio, this works perfectly fine. Why not? If you abide by the bigger picture and do not hold the trades for too long, cut your losses quickly, then it's very possible to make money here.
These kind of candlesticks typically lose, because everyone can look at these charts. And if you have the same information as anyone else in the market, it's likely that you're not going to have a great edge on
I have to disagree.
everyone else, because in the market you need to have an advantage. And the next type of chart,
at the end, the market spikes in direction. Like this long move is more or less a spike in which most of the market participants agree on a direction. Okay, so it's good if everyone sees that, because then they're gonna be on your side.
Chart solves exactly this problem. So
And
let's
the few that are selling, providing liquidity for the market to even move higher. If there's no liquidity above, the market has no chance of moving higher. Okay, so there need to be sellers on board as well.
activate the volume profile. This chart is called the volume profile chart, and it basically shows you not just where price went, but how much money was traded.
Yeah, but that's what I've told you previously. The volume profile, I'm not the biggest fan. Okay, you got the value area high, low. At the point of control, there's usually a little bit more going on, a little choppy. But at the end, you're gonna see those. Look at this example here where the point of control is in this chart. It's obvious that something is going on at this price level. If I want to trade the next day here with the volume profile, no, okay, yesterday's point of control was at this level. But look at this, guys. It's so obvious that there was big volume here, and now this will act as support or resistance. I do not need a volume profile for this.
At price. I can also just get rid of price and just look at these areas, these orange levels that tells me where most money was traded. This is a low volume node, a place where little money was traded. This was traded.
And then there's always this saying, okay, you got different volume profiles, like this one here is a D profile. And then we got those examples where we have a P profile, and that usually means that we're gonna see higher prices in the next day because the volume shifted from lower prices up to those prices here and accepted those prices. So we might see some long momentum continuing, but I also see that in the candlesticks.
Areas, these orange levels that tells me where most money was traded. This is a low volume node, a place where little money was traded. This instead is the place where most money changed hands, where big banks in financial markets and the institution that moves markets actually did business at. So I can see how money moved upward and upward the entire session, not based on highs and lows on random price candlesticks, but based on the money. That's why professionals use this type of chart. But the next type of chart is even cooler, and it's called the footprint chart. So in a platform like Deep Charts that have footprint charts.
Okay, a footprint chart. What do I have to say about a footprint chart? Actually, in today's times, no longer needed. If you want to use level 2 data, you probably are using a heat map where liquidity and stuff can be beautiful seen, and there is no need for a footprint anymore. Footprint maybe was good 10 years back, but 20 years back, but not anymore.
Enabled. If you zoom in close enough, you're gonna start noticing some interesting details, which are all.
Now I get a volume profile for every candle. You might trade that, for example. Here's a good example. I immediately sense that. It's a little cut off here at the bottom, but doesn't matter. So we got this big volume here in this long candle. Maybe it was a P profile. And then we open short, and then we can say, okay, the market is gonna find support right here where this big volume was in the previous candle, and that worked out pretty good here. So we got a little retracement back to the big volume and then a spike higher. Okay, this is how you could in theory trade the volume profile within the 5-minute candles. Okay, again, same example here. Here was the big volume, candle opened, retested the big volume of the previous one, and then moved lower in the direction. Okay, is that really needed? I don't think so.
All these numbers. And I know this might look complicated.
Because there, again, are enough examples where this won't work. So just trading that probably won't give you the biggest edge.
But stick with it because this is where the money is made. This type of chart doesn't only show you candlestick, but what happened behind them. And you can clearly see something big happened right around here.
Yeah, and then the market retested that before going higher. Okay.
Where sellers who were dominating the markets and pushing price down made a huge effort over here with this 2.6 thousand contracts. But these thousands of contracts of sellers didn't push price down as you'd expect.
So that's called an absorption, and an absorption can be probably seen better or at least as good if you are using, for example, a big trades indicator or just a heat map if you want to trade stuff like that.
They were all absorbed up on this level, which means there's a buyer behind, a very big buyer, absorbing all of this selling pressure. And right after that happens, price moves up for the entirety of the session. And with a normal price action chart, you would not be able to see this. That's why
Now, the thing is, again, how are you able to trade that? We got obviously here a bullish pin bar. This is a 5-minute chart, so you might get enough reaction time. But overall, it seems like the market is coming from higher prices here, okay? So we are currently trading lower. Now we are printing a bullish pin bar, which on its own might be an indication to you that momentum is shifting long and you can at least capture some points to the long side, maybe to a previous support that it might now act as resistance, okay? Something like that. Yeah, why not? That could be a theory, but it isn't always the case that the market will retest the high volume of this bullish pin bar before then moving higher. There are enough occasions where the market is just shooting off. Whoops, that was the wrong tool. Where the market is just shooting off without retesting, okay? So putting in an order here at this level with a stop loss below would have perfectly worked in this example. There are enough occasions where the market is not retesting, okay? So maybe you are going long here nevertheless, just because it's a bullish pin bar. And then this big absorption down here doesn't help you anything, because the bullish pin bar can also be seen in the candlestick chart without the footprint, and the retest might not even occur. Of course, in hindsight now, it's perfectly fine.
Professionals love this type of chart. And you can see this every single day.
Look at this. This is more or less a bullish pin bar. Was the big volume here retested before going higher? No. The market immediately shoots off points higher without retesting this. So, okay, this is not as easy. So, do you really need the footprint? In my opinion, if you are using a heat map, definitely not.
In the market, a big seller is absorbed and then price moves up. Another big seller is absorbed and then price moves up. So with candlesticks, you're always late to the party. With footprints, you can actually see things before price action traders can realize. But to zoom in and actually look at these big orders can be a little bit of a headache. So the next level of chart, which is even cooler, is called deep trades. So with this type of chart, you get rid of all the small numbers and you only filter out the big ones, the only orders that matter. When you see big bubbles at the bottom of candles, it means there's a huge buyer stepping in, pushing the auction up. And when a big seller tries to sell and push the auction lower, but is completely absorbed, price then booms.
Yeah, but is this again something you can purely trade off? No. Look at this example. Buyers got absorbed here. If you try to short this after the candle close, you would lose because the market is spiking higher. If you try to wait for a retest of this area, you would lose because the market is spiking higher. Okay, just purely trading those big trades indicators where you can see absorptions and stuff like that won't work.
Up.
It might be a good indication additionally to something, but in the end, most of those examples where we got those big absorptions, as you can see, are already printing pin bars. We got a big absorption here, but again, this is a bullish pin bar. So also without those indicators here, I would have seen that there was an absorption down here. Same goes for this one here. Bearish pin bar, okay, body is still bullish, but there was a deep sell-off, okay? I do not need this bubble right here. Again here, pin bar. In most of those examples and in a candle like this, in a breakout candle, do I really need those bubbles here? Do they help me? Okay, look at this, the market retested this level here and then moved higher. Okay, you could in theory trade that, but you could also try to say, okay, I'm laying a Fibonacci retracement over this candle, and then this would be probably like the 38.6% level or even the 50% level, a little lower, where the market found support.
And price stops exactly where these big buyers are getting absorbed by passive sellers. And price drops always stops when a big seller is being absorbed. So with this type of chart, you can time the market by following what big market participants, aka the smart.
Again, not so easy, huh? Look at this example here. Got the pin bar, we got the absorption, but the market made new lows before making the long move, okay? So putting the stop loss below this candle, you would have been stopped out. It's not that easy, okay? The market is efficient in those things. If this would work, people would make millions so easily, okay? But the market is so efficient that there are at least 50% of examples where the low will be taken out before a move occurs, or the move won't occur at all, okay? Not that easy.
Money are actually doing with their orders. But this isn't even the coolest part yet, because there's a way to see these bubbles before they happened, and that's exactly the smart.
And let's take a look here at the overall picture. Do I need the volume profile to identify that higher prices got accepted here at the end? Probably not. Again, the market is spiking higher, and then we can see in the candlestick chart alone that those higher prices kind of made an accepted price level here.
Money are actually doing with their orders. But this isn't even the coolest part yet, because there's a way to see these bubbles.
But he's not talking about the money he has to spend on those different charts, because usually all of that here is included in most trading and most future trading softwares, okay? They probably cost you something each month, maybe even not too little, but definitely not $1,000. Maybe like $50, $60, $70 a month, and then all of that is included.
Before they happened. And that's exactly when the liquidity heat map steps in. Let's take this.
Now it gets a little more interesting, because the heat map combines all of that.
Chart as an example. Right above here, there's no big bubble really, but we see price approaching the high and then get immediately rejected. And in this case, neither price or the bubbles can tell us the story of what's happening behind. And that's where our heat maps comes in, because the heat maps gives us the final piece of information that you actually need to take informed decisions. And this type of chart shows you with these hot areas if there are some big sellers in the order book, which is the passive side of the market, willing to sell huge amounts of orders. And if you actually look at the numbers below above here, you had thousands and thousands of sell orders being offered at these prices. So of course buyers were scared.
Again, usual behavior in a situation where the market is just rising, liquidity gets taken out again and again and again on higher prices, and new liquidity gets put in on higher price, on higher price, on higher prices. Yeah.
Of approaching all of these sellers, because these huge sellers might know something you don't. So you cannot see this from the exact same price chart. You can only see this through liquidity areas. So you see price approaches this level and then immediately shies away, and as soon as these sellers could not get their fill, they canceled that order and opened market instead, and this huge bubble appeared. So they were not willing to wait anymore, so they sold.
I'm not too sure about that, because this seems like a big example of spoofing. So the order was not real. There were no sellers who really wanted to get the fill up here, because otherwise real orders usually have a big history. Okay, they go back a couple of minutes or hours or even days in which they are trying to get filled. But as you can see, the market is now moving higher, and then close before the liquidity would be hit, got some spoofing, and this big institution whatsoever put his order higher so that it won't get filled in this example. And maybe that was some kind of reason why the market was trading lower than
market. And then reloaded more sell orders right here.
Again, this more or less wasn't filled. Again, spoofing. As soon as the market came back up here, order was taken out.
So these areas act as an attraction level and as a rejection level. You'll see price gravitating towards these areas, and if they're strong enough, price rejecting immediately from these areas. So right over here, we could see that a big bubble of buyers got absorbed from a huge sell liquidity, which is exactly this level over here. But with the heat map, we knew that a big trade was going to happen here way before it appeared on the chart. And as
So why did the institution did this here in this example? Maybe they were in a long position and they wanted to attract higher prices to get better fill for their position close. And I could think of an example where they saw, okay, market is coming to this location. Now we're gonna move it higher. Maybe we can attract the prices even a few points higher. This wasn't working. Let's see where the position was taken out. It's taken out right here as soon as the market broke the lows. This seller might have started selling market.
You can see price gravitates towards the area, buyers get absorbed at that level, and price melts for the entire session and melts all the way down to the furthest liquidity areas there is. And as
Yeah, but this liquidity also was put in at this level, more or less attracting the sellers lower.
soon as you
So it wasn't a liquidity that was in long before.
see big buyers joining the party,
But I would say this is a great tool because it combines everything. The volume, the absorptions, whatever. Okay, everything is included here. So if you want to have that additionally to your candlestick chart, I think that might make sense because everything is combined. Do you really trade better with that? Probably not. Everything goes so freaking fast. The only thing where it might help you is, okay, identifying the market structure because of the bubbles. It might be a little easier. But based off the liquidity heat map here, how might it help you if you are in a big trade, in a big position, and you try to think of a target and you see, okay, liquidity is being put in at lower prices consecutively, then you might still hold on to your position because the market is usually trading lower with new liquidity coming in. So might go even lower at this point. If the liquidity dries out, you could think about closing a position. Okay, stuff like that.
on the passive side, that's exactly when price reverses instead. This software is called Deep DOM. It's very easy to use, very easy to understand, and doesn't have 100 different things to manage. It only shows you what matters. And we're finally about to release it on May the 8th. And if you want to, only shows you what hands on the same software.
Okay, so this was also a little advertisement on the software. In general, it was a good video. I had a lot to say about that. Hopefully you enjoyed my educational side again today. So I want to find a good balance between just purely entertaining trading videos and also those educational ones. Usually I have a little bit more to say on those educational videos with all of my experience from years of trading. Still deserves a like because he explained so the overall big picture of different chart types and what there is with volume, etc. So for beginners and starters, they get a pretty good overview of what there is. Hopefully you guys could also learn something from what I had to say here today. Thank you guys for watching. You're gonna see us in the next episode. Leave me down in the comments what you think about different chart types, what you use. Do you have experience with heat maps, or do you just say, okay, I invested my whole money into all of those different chart types, volume, whatever there is, and it didn't make me any more profitable? That is probably the case. Okay, if you are profitable in the heat map, you might also be profitable on a pure candlestick chart, and if you are not profitable, then you probably won't be on any of those fancy charts. Thank you guys for watching. We're gonna see us next time. Take care of yourself. Bye bye.